Good morning, good afternoon, good evening, wherever you are. Welcome to Breakout Trading Answered, the show where we talk about all things breakout trading. And this is the first show of the year. Welcome. And of course, joining me today is Breakout Trading Specialist, hedge fund manager, and guy. He looks a little bit cold. He's got his jumper on today. Welcome, Thomas.
How are you? Hi, Andrew. Hi, everybody. Glad to be back. First episode in 2022. So everybody, welcome to the new year. Welcome to 2022. We both hope that you will have a phenomenal year, 2022, with a lot of trading success and, of course, success anywhere else. And Andrew, I wonder who's here tonight.
I don't know. Let's check out the chat. Good morning, good afternoon, good evening. Say hello in the chat. I've got no chat here, so maybe there's something wrong with my screen. So we'll give it a moment for people to reply. So I'm really excited about the show today, Thomas, because I know you've got something special, something I think unique and new to share with us. So I'm really looking forward to seeing what that is. You've got me intrigued. So
Great.
Yeah, we've got a couple of hellos in the chat now. Olga, g'day, Olga. Hey, Martin, good to see you here again. So thanks for joining us. All right, so just before we get started, Thomas, I just wanted to mention actually that our last call, which was 2 weeks ago, was about the 28th of December. We had a really interesting episode. We talked about 5 steps to successful trading in 2022. And it wasn't, I think it was a little bit different to what people were expecting, but the feedback was amazing. People really enjoyed that. So if you haven't seen that one yet, I recommend go back and have a look at that one. It was really good. That was 5 steps to successful trading in 2022. Now we're getting more hellos in the chat now. Hey, Yerka. G'day. Hey, Gus. Good to see you here. Bruce and Egyptian Trader is here as well. So we've got a nice little group going so far. Welcome.
Great. Welcome, everybody.
Now, Thomas, where do we start for the show today?
3 professional tips, right?
Yeah, that's right. Yeah.
We want to be professional traders in 2022. So I thought we should really start with something professional, not to hold back much. And let's do it. Let's do some fancy stuff.
Exactly. Looking forward to it.
Okay, so I've prepared 3 professional tips for you guys tonight. And again, this is professional. We're not going to talk beginner stuff tonight. So get your brains ready because we will definitely challenge you in a positive way. And I also have, as Andrew said, that there's a little bit of a surprise today because I decided to prepare a new format. The way I'm going to present all these ideas with you. So I decided to use a technology, and it's going to be my remarkable paper. And this will be connected online. It is already connected online to my computer. So I will be drawing, and you will see me drawing in real time. And this way we will explain all the concepts in a new way to you, a better way, hopefully. So that's going to be exciting. But we still have some slides to cover before we start. Actually, we have one. So what we will talk about, let us share with you.
Oh, you want me to put up the slide?
Yes, please.
You caught me unprepared. Hang on, let me go back a few. I had it on one of the late slides. Here we go. Coming right up. Click, click, click. Here we go.
And that's it. That's what we're going to talk about. Thank you. Awesome. So I'm going to cover 3 professional tips for improving your trading results in 2022 or anytime, not just in 2022. And I'll share with you 3 advanced but very important concepts, which are the first one is think volatility composition. The second one is system sizing. And the third one is create adaptive environment. So I hope everybody's ready. And Andrew, may I share my screen now?
You may. Let me click this one off. And
okay. So hopefully everything will work out well and properly. And let's do it.
Okay, here we go. Boing.
All fine? All visible?
Yep, can see it.
Great. Okay, so I'm going to. I cannot see myself right now because my whole desktop is this remarkable drawing board, but I hope that's okay.
Yep.
So I'm going to talk about something that I call volatility recomposition, and I'm going to explain why I call it this way, because it's there's a connection to my past life. It almost feels like past life. I don't know, guys, if you knew, but I originally studied at film school, and I used to work as a movie and TV and film director for a while after the school. And in the movie industry where I used to work, we very often used to use the term of composition. And composition is basically that you have an actor. So this is my best drawing I can do, guys. This is my actor. It will not get any better than this. And then you have composition. So you want to compose this actor in certain way into the movie screen. So this is called composition. And now that's the basic cinematography. This is like, okay, we need a nice, good-looking composition so it looks good and cool on TV or in the cinema. And that's basically what we call composition in a movie. Now, here is the trick. In movie, most of the time, especially if it's an action movie, we have movements. We have one actor is chasing another. So we have all these action sequences. And then what really happens is that once the actor starts moving because some other actor is chasing him, you cannot keep your original composition anymore, because if you keep the composition, your actor will get out of the screen in a couple of seconds, and the audience will be looking at an empty screen. So that's why we need to move camera with the actor, and we call this recomposition. So we move the camera, and as the chase is happening and the villain is entering the screen and the hero is running away, we move the camera and we recompose. This is called recomposition. And this is quite a difficult task. And that's why camera operators are pretty well paid people, because they really have to have all this in eye, and they have to be able to react very quickly. And because every shooting costs a ton of money, they don't have much of a room for mistakes. So that's why camera operators are constantly recomposing, and they are very well paid because they have good sense for that and good practice, good training. So how does this relate to markets? So this is the idea of recomposition, which pretty much is same in trading when it comes to volatility. Because the problem is that you can create a strategy, and let's say we have a volatility measured as, let's say, ATR output. We use average true range, and let's say on our current market, the volatility is 15. We can just make this number up. So we create a strategy which pretty much works on volatility 50. Now, what happens if the volatility starts running like the actor in our screen, and it will all of a sudden get to 70? What happens? Any idea? So what really happens is that our strategy might not be well fit for this sudden volatility jump. Let's, for example, say that you have optimized your stop loss, and your stop loss is $500 US. Now the volatility jumps to 70. So what are the odds that $500 will be still a viable stop loss?
It's probably not going to work very well, right?
Yeah, exactly. Might not work at all. So that's why we also need to bear in mind that if we want to survive in markets, we always need to recompose our strategies for volatility. So that's very important. It's same like with shooting a movie. The markets are always moving, and we're moving the frame, the camera, we have to keep moving it with markets because we need to recompose for these changes in volatility. Now, there are some techniques that are pretty simple and can be already built in a way that the composition happens automatically. For example, if we use ATR, average true range based stop loss. So we can say, okay, so my stop loss will not be dollar based, but will be, let's see, 3 times of volatility of the last 14 bars. So in this way, can you hear me?
Yeah.
Hello. Oh yeah,
yep. You can hear you.
Yeah. Okay. So in that case, you already have an element which is automatically recomposing for the volatility. But this might not be enough because you can have more components. So that's why we can use a pretty simple technique for volatility recomposition, which is that you basically understand that there are changes in volatility, and then you create a framework. And then you create a framework in which you assess your strategy in different types of volatility. And I'll give you just very basic idea right now, but let's say you trade a strategy on a certain market, and that market, most of the time, the volatility fluctuates between, let's say, 30, that would be the low volatility, measured with ATR, average true range, and high volatility, which the maximum could be, let's say, 80. So what you should really do, at least, you still need to understand that this is like the movie, like we need to keep recomposing our strategy as the volatility keeps changing. So one of the easiest way, but pretty powerful, is that you always know your highest levels and lowest levels of volatility, and then you split this range into 2, and then you test your strategy for this high volatility and low volatility circumstances, market circumstances, which would be, so if this is 30 and this is 80, we have 50 difference. So that would be 30 to 65, right? And then 65 to 80. Is that right?
55, I think.
No, 55, yeah.
Yep.
30 to 55. So then you basically take your strategy, your code, and then you ask, well, you have to write a code, and you ask, what happens with my strategy if I test it in low volatility between 30 to 55 and in high volatility between 55 to 80? And it can happen, and it will happen quite often, that, for example, all of a sudden for low volatility, your equity curve will look like this. And for a high volatility, your equity curve will look like this. So if you see these 2 different pictures, what is it that you're actually seeing?
Is that a question for me?
For the audience.
For the audience. It looks like we've got a little bit of a delay in streaming today, about 15 to 20 seconds. So it might take a bit of time. Okay. So I'll answer for now until that fixes itself up. But yeah, so what are we seeing here in the 2 different pictures? Was that the question?
Yes.
So we're seeing that the strategy seems to have better performance in a particular volatility conditions than the other one, right? That strategy results on the right seems to be much more what we're looking to achieve than the one on the left.
Right, exactly. So you might be basically seeing that your strategy is not fully adaptable to changing volatility conditions. So your strategy can be constructed in a way that doesn't really have all the necessary components to be fully adaptable and flexible. And obviously, now you can see that the strategy works only in high vol condition, but might not work well in the low volatility condition, which is a pretty serious and important realization, because now you discovered potentially a reason for a lot of losing trade. And also what happens if the volatility drops, if the volatility drops in markets for a couple of months, you'll have a long losing streak. So now what you really need to do, you need to take this information and work with that accordingly. And one of the way how you could, of course, work with this information is that you will restrict trading in low volatility. You will make a condition that between 30 and 55 vol, no trading. You will prohibit any trading in volatility between 30 to 25. So that's one possibility. And then you keep your strategy just for high volatility, because there's no automated recomposition built in the volatility. But the other thing is that what really could be a cause of this poor performance in low volatility could be, for example, your stop losses and profit targets, especially profit targets. If you have generally higher profit target and you are working in low volatility environment, it's logical that your profit target might not be hit as often as it is high volatility environment, which causes more than normal amount of losing trades. So what you need to do in that case, if this is that case, you need to recompose your stop loss or profit target. So in that case, you basically need to analyze what would be your ideal profit target or stop loss, or both in low volatility and high volatility. And then you can arrive to something which can be like, here you can have stop loss 500 and profit target 1500. And then in low volatility, usually the stop loss is quite the same or similar, or can get a little bit lower, but profit target can get way lower. So you might realize that you need 1000 profit target in low volatility instead of 1500. So now you're making more of a volatility recomposition built into your strategy, because now you are ready for both volatility states. Of course, if you have get good equity curves in both volatility states standalone, you do have a good strategy which is able to recompose automatically. So you will also have strategies like this. But if not, then you really need to do one of these tricks to make your strategy viable or also tradable only in the right market environment. So that's volatility recomposition. Let's see if we have some questions regarding this.
Yeah, we do actually. So
Great.
There's a comment here from Neil.
Mm-hmm.
What about if you just make the targets and stops relative to volatility rather than fixed?
Yes, that's what I suggested at the beginning. So you can use ATR targets and stop losses. The trick is that ATR-based stop losses and targets are not necessarily the best types of targets, and I think Andrew will confirm that. It's quite ironical, but out of a lot of research, dollar-based stop losses and targets still seems to be the best, at least according to our research. I don't know if you have similar experience, Andrew.
Yeah, we have actually. Which is, I guess, is counterintuitive, right? Because you assume that volatility base would be better, but often that's not the case. I don't know why. It's just that's what the data tells us.
Exactly. Go figure. That's one of the typical examples that theory and practice in trading are two completely different things. And often we have theories and assumptions, but then we test it, and the practice is completely different. So what do we go with? Our well-sound design theory or the practical numbers proving the case? Yeah. So we go with the numbers.
Exactly. Here's a good question from Martin. Thanks for the question, Martin. Is it better to recompose, optimize a stop loss, or simply avoid specific volatility? Which one has a higher priority?
That's very individual. That really depends on a strategy, and sometimes it can get even more complicated. Sometimes you can have average performance in low volatility and exceptional performance in high volatility. So what you can also do in high volatility, you increase your position, and in low volatility you keep your normal position. So this is very individual, and it always depends on strategy, cannot be just generalized.
Yeah, good point. Now here's a question from Mark, or I should say Egyptian trader. Now this one popped up as you were showing the two different performance results in the market regimes. So I think maybe this answer is kind of more towards the strategy that showed horrible performance. But I think it raises a bigger question about when you start adjusting the strategy for these different or recomposing the strategy for these different volatility markets. What happens to the robustness of the strategy then?
That's a very tricky question, because we always can take it too far. And that's especially common among beginning traders, that they start fine-tuning too many input parameters and they overfit it. So I only talk about stop loss and profit target, and I also said stop loss is basically and mostly the same. I'm only talking about profit target. So if we take it lightly like this, then that's a logical step, because in low volatility your maximum favorable excursion will be way different than in high volatility. So the risk of over optimization is pretty low, because you're just taking one step further the analysis of maximum favorable excursion. Now, to avoid this danger of overfit, you should make sure that you have a good sample size on both volatility types. So if you have, let's say, at least 100 trades within each volatility level, and the higher the better, then you are already mitigating this problem of overfit. But if let's say you have 500 trades sample size on high volatility and only 40 trades on low volatility, then you really don't have any reliable outcome and any reliable sample size, and you can overfit because 40 is not enough. And in that case, you could even switch off low volatility, because it doesn't trade often in the low volatility anyway. But the key is that you must not fine-tune all your parameters in different volatilities, and that's something I see quite often from beginning traders. They get this idea and then they optimize completely all the input parameters differently for each volatility level. And again, this sounds quite all right and logical, and it's got its reason. So I'm not saying that it's foolish, but practically, from practical standpoint of view, it can increase the risk of overfitting and over optimization quite a lot. So in that case, if you want to have deliberately different parameter sets for all your input parameters, all your indicators, everything that's built in the strategy for different volatility levels, then it's way better start developing deliberately different strategies for high volatility only and low volatility only, and design different strategies with this high volatility filter built in on already, and then with this low volatility filter on already, and then you have two complementary strategies for different volatility levels, which can be pretty handy, especially when markets start shifting its volatility levels.
Yeah. Okay. Thanks for that. We got a question here from Alex about cash stops. I'm not exactly sure what that means. So perhaps if you can specify a bit more, Alex, and we can ask that question. Okay, actually, we got a comment from Alex that came up quick. For Bitcoin on this problem using multi-charts, I guess, I used a cash stop and let multi-chart scale in the position. This way I can analyze the edge.
I don't trade Bitcoin. I cannot refer to that.
Bitcoin would be an interesting exercise, right, for this, because can have some very huge swings in volatility and very quickly as well. So
yeah, but also we have very short history, and we're not
Yeah.
able to assess this on enough of data. I think we have just like 2 or 3 years or how much of a history. So to me, it's still not product that I'm keen on, because we don't have enough data and enough market circumstances to test this properly.
Yep. All right, no more questions on this one. Seems to we got some comments saying this is a good idea, and that. So thanks for sharing that one, Thomas.
Great. Okay. So that was the first one, and again, it's up to you how you work with this, but it can be quite powerful. Now, there's another one, and this one is pretty big one, and by the way, also I forgot to mention, if you're really interested in working with volatility and in deeper work with this volatility, in the latest upcoming, so we published this magazine. It's called, or newsletter. It's called Empowered Trader, and it's it's just like this full color, full of charts and codes and ideas and analysis. And this is a special BTA newsletter which we publish quarterly, called Empowered Trader. We have also more contributors, and we share a lot of techniques like this, but in details with examples and codes and bonuses and stuff like that. And now in this upcoming issue, January 2022, I have a special article just about this volatility changes and volatility adoption. So if this is something you're interested in, then it's coming out, I think, this or next week, this new issue of Empowered Trader. So something to consider. I don't know if we can share some link, or maybe if you're interested, just send us an email, and our team will arrange with you.
Yep, I'll see if I can hunt down the link while we're talking about the next point, and then I'll post it up in the chat.
Thank you. So next one is quite interesting, and it's something that we use in our hedge fund. It's a term that I invented a couple of years ago, which I called system sizing. And this is really, really big thing in our hedge fund, and it's something that still few people understand. So there's a general perception that position sizing, especially old techniques of position sizing, will get you more money, and that's not wrong understanding. It will, but it will go with pretty high cost, and that is drawdown. Usually, the regular position sizing methods come with the cost of way higher drawdowns. And in our hedge fund, we're more after stability. We don't need extreme absolute performance. We need good stability. And I think that's the case for a lot of traders as well, especially if you want to make a stable income. So that's why we developed a concept that we call system sizing. And the idea is quite simple. Instead of adding more contracts or positions or lots or whatever, we keep adding more strategies, more trading systems. And I will explain to you why. So first of all, let's start with the question. How do you, and this is for you guys watching this show, and this will tell us how well you've been listening to previous episodes. What is the easiest and fastest way to achieve stable performance? Give us some educated guests.
Okay, let's have a look in the chat. Looks like there might be a little bit of a delay again, Thomas, by the looks of it.
That's okay. That's okay. No worries.
So the best way to, or some ways that you can use to have a more...
to create stable performance?
Stable
What would be your
performance, yeah.
best tool, best approach?
Okay, we've got comment from Bruce. Variation of systems. Neil,
Yeah, good
diversification.
one. Yeah,
Egyptian portfolio.
you guys
Alex,
are awesome.
diversification, uncorrelated assets and strategies, portfolio.
Yes. You all got it right. Great. You're paying attention. Good stuff, guys. Really appreciate you. Exactly. And now let me show you something. So let's say you have two trading systems. Okay, let's call them system 1 and system 2. And now the correlation between these two, let's say, is 50%. Okay. Now you're trading them and you're making money, and you start trading them with one contract each. So the correlation is 50%, one contract each, you start making money. Now you add a position because you made more money, and you add a position, and now you trade two contracts here and two contracts here. What is your correlation between these two strategies? We probably have some delay. Yeah. But obviously it's still 50%, right? Like just adding a contract doesn't change your correlation. It doesn't matter how many contracts you trade, you still have the same correlation, right? So you have two strategies and you have 50% correlation. Now, what happens if instead of second contract, you add another trading system? So you have system 1, system 2, and now with these two, you have correlation 50%. But what happens if you make money and you say, okay, instead of adding additional contract, I will add third strategy. And now if you're clever about that, you add another strategy and you decrease your, which is low correlated to the first one and second one, and you decrease your correlation to 30%. And then again, you keep making money. So you add fourth strategy. And if you're clever enough, then you will add low correlated to these three ones, and you drop your correlations to 10%, okay? So what is now the fundamental difference between this scenario and this scenario? And I'm waiting for your ideas, guys. What is the fundamental difference? So I can see.
So the comments coming through now, I think, are for the previous question. So there still seems to be a bit of a delay today for some reason. Not sure why it's such a long delay. Yep.
Yeah, I'm still curious if we'll see our answers coming in. So what is it? Risk management is the only thing to make math approach to markets. More stability, smoother curve. Yes. Who is it?
Neil.
Exactly, Neil. Exactly, Neil. So now you have, first of all, you have lower correlations, which means that you can create smoother equity. But so you immediately got first benefit. The second benefit: what happens if one of these two strategies fails? Well, you probably will lose money on that one. And maybe with these two combines, you'll be sometimes around break even. Whereas if this strategy, same one, strategy 1 fails here, what happens? You still keep making money because you still have 3 more which are not failing. So you diversified your risk of failure, because even if first and second strategy fails in the first scenario, you're immediately going down with your trading account. If this same things happens with the second scenario of system sizing, you can be break even, you still can be making a little bit of money, but you're definitely of much better scenario than the first one. Okay. So that's why position sizing, from my point of view, doesn't make much of a sense it can get you faster to absolute return, but the risk is too high, because not only you're risking higher drawdown, but you're significantly increasing the risk of failure, and you're also not doing the most important thing that you should, and that is being well diversified among strategies with low mutual correlations. So that's why system sizing is way more professional approach to not only create more stable income, but also to hedge your bets, because now I've hedged first and second strategy with third and fourth one, and I'm constantly hedging myself from different perspectives, while also decreasing quite significantly my correlations, and thus being of to better overall performance and stability. Does it make sense?
Yeah. Yep. And it looks like in the chat, people get the concept. So that's good. More stability, more stable, smoother curve, lower correlation, more balanced equity curve. Each strategy has lower weighting. Therefore, portfolio is much more diverse.
Yeah,
Actually,
exactly.
we do.
Guys, that's it.
Oh, sorry, Thomas. Sorry to cut you off. We
Yeah.
do have a question here
No,
from Alex.
Yeah.
Do you have favorites in your portfolio that you put in more weight?
So if the question is about how to weight the portfolio, that's a little bit more complicated. I never weight my portfolio based on favorites, because I do have favorite markets. But if I combine my favorite markets, the correlation will be pretty high. So my intention is to be totally unbiased and just throw in any strategy on any market that will give me low correlation. So my overall approach is to, or I'm saying mine, but it's actual approach of my hedge fund, is that we constantly keep creating strategies across all markets, and then whatever combination give us the lowest correlation, that's what we go with, and doesn't matter what market or time frame it is. And this is also one of the reasons why I constantly keep saying.
Thomas, I think we lost you. Are you there? I think Thomas' internet might have dropped out for a moment there. We'll give him a chance to reconnect. Maybe his Remarkable ran out of power. We'll have to see how he goes. So how are we doing with the first two concepts? Do you have a favorite? Oh, Thomas looks like he's back. Are you back, Thomas?
Yeah, sorry. All of a sudden, I had this internet drop for a couple of seconds. Yeah, we're back.
All right. Welcome back.
Yeah. Okay. So what I was saying is that this is also one of the reasons why I keep saying that we constantly need to create strategies. And a lot of traders, they still not getting that. They're like, why? I create my 5 strategies, super portfolio, and now I'm free, and the sky is blue, and I'll keep making money. Well, you will. If you have great strategies, you will keep making money for a while. But then what's next? Then you want to make more money, so you want to start position sizing. And then if you start position sizing and it will ignore system sizing, you're basically giving yourself a big disfavor, because now you're not a risk manager anymore. You're not managing your risk. You're just foolishly adding positions without really understanding what you're doing, that you're keeping your correlations and all the risk. So that's another attribute which is important to understand, why we need to keep creating strategies. Unfortunately, the good part about this is that we can automate the strategy creation process, and we don't need to do this manually anymore. But we still need a constant flow of strategies, because if we want to grow, we need to grow with new strategies being added to portfolio and not with position sizing. At least this is my philosophy. And this simple example and simple correlation math should be more than enough of a proof for you that this is what you should pursue it.
Yeah. Okay. Thanks, Thomas. It looks like we've exhausted all the questions there. So that was system sizing. The first topic was volatility composition, and system sizing was the second one. Actually, we got one more question here, which is a pretty cool question. So we'll post this one, and then we'll move on to the third point. This one's from Pete. Welcome, Pete.
Hey, Pete.
How do you integrate position sizing and strategy or system sizing?
Quite honestly, we do not work with position sizing at all. We only work with system sizing. And when we work with, well, let me rephrase it. We do not work with classical position sizing like fixed fraction or all these normal position sizing position sizing methods. We do not use them at all. We use system sizing, and then as an element, we use so-called dynamic position sizing. But dynamic position sizing, it's a little bit different concept. So because we trade a certain amount of money in hedge fund, we never trade just one contract. Even if we have 100 strategies in a portfolio, each strategy by default has got already 3, 4, 5, even 10 contracts. So what we do to even let's say, give more of an advantage to ourselves. Once we have these, let's say, even three default contracts on a certain system, we then use techniques called dynamic position sizing, which we again develop in our hedge fund, and it's basically a technique where we assess probability of the next trade being a winning one, and based on that we assign either 1, 2, or 3 contracts. So we don't use this classical position sizing method, but we combine heavily system sizing with dynamic position sizing.
Yep, well said, Thomas. And just actually a sneaky little question here from Martin before we move on. Martin submits good questions. When you illustrated the 4 strategies as opposed to 1 or 2, were you talking about correlation of strategies and profits without regard to direction, long or short?
Yes, exactly, Martin. We're talking about the overall correlation. Most of our strategies in hedge fund are both sides, long and short. So the absolute correlation, and we personally in hedge fund, we measure weekly correlation. We're not so much worried about daily correlation. We measure weekly correlations. That's the most important metric for us.
Yep. Okay. All right. I think we can move on to the next one, Thomas.
So that was the second technique, and then third technique. This is quite obvious, and it's quite easy, but it's about creating adaptive environment. I hope I spelled it well. Sometimes my spelling is horrible. So we already know that it's all about adaptivity. That's something I've been talking about quite a lot today. And also, if you are already members of the BTA community, you have access to our community forum. And today I posted there a special video, which is called "What is Robustness?" And in this video, I explained that robustness is basically nothing more and nothing less than the ability of a trading strategy to adapt. So it's all about adaptivity. Now, one thing is that we need to adapt with carefully chosen components or techniques built in or embedded into our trading strategy. So of course, ATR-based stop losses, profit targets, that's adaptive component. The volatility recomposition, that is adaptive tool. It's a tool that how we adapt to different volatility conditions. Dynamic position sizing, it's a tool how to adapt to different probabilities of trading outcome. But overall, the easiest way, or maybe not easiest in a sense, but one of the, let's say, fundamental way to really make sure that we are adapting well is create adaptive environment. And by adaptive environment, I mean a procedure. It's like more like procedural thing that really helps you with market changes. And adaptive environment is nothing more and nothing less than regular reoptimization. And regular reoptimization, it was my big bulb, light switch on. This is light switch on bulb. It was my big realization sometimes 8-9 years ago, when I did a live trading experiment, not a paper trading, not just testing, but live trading experiment. And I had a couple of strategies, and I decided to trade them for 1 year one set of these strategies was trading with optimized parameters, which I optimized on a long history, some 8, 9, 10 years. And these parameters were really robust among the entire history. And these parameters were not local optimums. These were global optimums. So that means these input parameters were not optimized to its peak performance, but rather all these input parameters was global optimums, which means any surrounding nearest neighbors were working very well as well. So these were very robust parameters, because you could shift these input parameters by increment minus as well as by increment plus, and you still could get great result, because these were very strong global optimums. And then the second set were parameters that were more towards local optimums, but were constantly, if I remember well, every 3 or 4 months reoptimized. Mm-hmm. And the result was quite astonishing, because that particular year, strategies that were optimized did almost 300% better than these with very robust global optimum fixed parameters. Wow. And that was that was a huge, I agree. Yeah. That was a huge result, huge difference, huge. It really got me. It surprised me. I didn't expect that big of a difference. So that got me really thinking, because before that I used to use fixed parameters with very strong global optimums, which had it rational. But then after this experiment, I switched completely to regular reoptimization. And I've done a lot of research on that. And that's basically what led me to the first framework of the breakout strategies development, which I now use in my hedge fund and which I teach in the breakout strategies masterclass, which is based on this adaptive environment, and regular reoptimization is crucial part of that. And from all my findings, regular reoptimization is the best adaptive environment that you can create for your strategies and for your trading. We done a lot of research on this one in hedge fund as well. And sometimes we had also quite heated discussions, because some members of my hedge fund team, they still believe in fixed, robust parameters working well on global optimums or whatever. But even after these discussions and further testing, we always get back to regular reoptimization. And my experience is that regular reoptimization is best anywhere between 3 to 9 months. So it's usually 3, 6, or 9 months. Fortunately for us, markets do not change that quickly that we would have to do it every month or every week or every day. And we did try this. We simulated reoptimization even on daily basis. And surprisingly, this did not work, at least in our testing, didn't work well at all. Even weekly basis didn't work well. Results were worse. Monthly didn't work well. But right now, and this finding is already a couple of years, maybe 5, 6 years old, and it's still valid. It still applies 3 to 9 months long term seems to be the best optimization period. So it's really important to understand that you need to adapt and you need to reoptimize. And even if you think you have a robust strategy right now with fixed parameters, and even if you cross-validate it on different markets and you cross-validate it on different timeframes, I'm not saying it will not keep working. It might, but I'm just saying that from our research, going with regular reoptimization can be not even way more profitable, but also less riskier. So that would be my third professional advice for 2022. Create this adaptive environment for yourself and your strategies.
Yeah. Well, that's exactly one of the questions we got in the chat from Neil. Thoughts about some people using fixed parameters across times and markets, for example. The 10 and 8 moving average channel, 8, 13, 21 ribbon, or the 50, 200 SMA, which is a very popular one we always hear about.
Yeah, this is a little bit. This is a little bit two-sided because, for example, yes, I agree with you. This is a great point. Was it Neil?
Yeah, it's Neil. Yep.
Yeah, Neil. 200 moving average. This is like, I would say, golden ratio of trading, right? Like we all know 200 moving average, and sometimes we put them into our prototyping, into our code just with this default period. There's not much to really work with. I agree. This is not an input parameter that you necessarily need to reoptimize. Totally with you. But your strategy, it's got way more input parameters. You have input parameter for ATR, for stop loss, profit target, for another indicator that you can be using. You can maybe use some price action that might need certain days back. You might use some trend filters like ADX or DMI, which have input parameters, and these all. From my experience, it's way better to create adaptive environment for them. And again, I do know traders who can trade with fixed parameters for a while, and I'm not saying it's not working. It can work even 3, 4, 5 years. I'm just saying that from all our research and my own experience, creating adaptive environment, you're definitely mitigating a lot of potential problems and risk in the future. And surprisingly, you're also giving yourself a chance to make even more with these long term. So that's the point.
Yep. All right. Thanks, Thomas. We've got a few more questions here. This one is from Martin. So with that said, is it also our goal for Breakout Masterclass members to in 3 to 9 months revise and reoptimize all viable candidates?
Yes, Martin. And Martin is part of the accelerator program. He joined us just recently. He's a great, very focused student. So Martin, we will talk about this in the accelerator, I think in 6 or 8 weeks, but it's on the schedule. We will talk about this and that's what we will do. Exactly. Yes.
Yeah. Okay. Here's one from Pete. Well, second question from Pete, actually. What's your experience with using adaptive indicators within a strategy?
Well, quite frankly, we don't have the success we expected with adaptive indicators. We still keep seeing that normal indicators for some reason work better. That's at least our experience.
Yep. Question here from Alex. Even if you reoptimize the strategy, do you monitor the old one and follow its performance for a case that it's collecting momentum to turn it live?
No. Once I reoptimize, I'm done. It's like it's past strategy that was optimized on different market conditions, but circumstances has changed quite a lot in 6 to 9 months. That's a long time. So that's all. That for me, that's obsolete. I don't look at it anymore.
Yep. Okay. That seems to be the last question on this topic. We do have another question from Alex, which was posted a few minutes ago for the last one. So we can come to that in a minute. Did you have anything else to add to this third point?
No, that was my third tip. That's it for today. That's all for about these professional tips for 2022.
Okay, excellent. Now, I know we've got a quote of the day, but first, let's just do a quick recap of the three topics that you shared. So the first one was volatility composition. You were really looking at the strategy across different volatility regimes to see how they perform, and then potentially adapting them based on those results. The second one was system sizing. And then the third one that you discovered was create adaptive environment. So that's 1, 2, 3. So do you want to look at the motivational quote?
Yes, please.
Is that the next step? Let me put this up on the screen. I'm interested to see the results, the feedback from this one. Here we go, coming right up.
So, guys, who can crack this code?
Let's see in the chat.
Who will be the first one?
It might be the fastest typist, I think, typer.
I think the first one. Who will get this quote? I think the first one who will crack this quote is the one who's ready to create really adaptive strategies. Is the one who got the whole point of this live event, live broadcasting.
Yeah. Neil's cracked the code. It's from Stephen Hawking.
Did he?
Yep.
Oh, great.
So he can understand it. Thanks, Neil. Yeah, and Martin. So yeah, people are.
Okay. Intelligence
Alex,
is the
Rob.
Ability to adapt to change. Yes, who did say
Yes.
it? Rob. Yeah, Rob, you're the winner. You got it. Yes. But sorry, Rob, just after you, Egyptian trader, just after you, who is the next one?
I think Neil came in first, but I'm not exactly sure if this is in order.
It looks like, guys, you almost all of you came in
at the
almost
same
the same time. Yeah. So you're all great, guys. You got it. Yeah.
Yeah.
You got it. Smart guys.
Yeah.
I wouldn't expect anything less.
I think this is a really good way to summarize the 3 points that you made today, because it really was about adapting to the markets, to volatility, and also at the portfolio level with system sizing. So did you want to add any more comments to this quote?
No, that says it all.
That's it?
This is the best self-explanatory quote I've ever seen.
Yeah, excellent. All right, so we'll start wrapping up in a minute. I'm just going to scroll up through the chat and look for the one from Alex, because I know he had a good question here. But while I'm doing that, if everyone could please give us a big thumbs up and like on the video. It's important to get your feedback, and it helps us to share it with others. So,
and especially, please, give us a thumb up if you like my drawing, and if you want me to keep going with these drawing examples, then give us thumb up for sure. So
I think we I think we actually got some comments about nice drawing. I know I saw Egyptian trader say that. So I think.
Right. Thank you.
I'm still looking for this question from Alex. One moment. There's so much messages in the chat here. Alex, where are you? One moment. It was something about. Oh my goodness, I've lost it now. Oh my goodness. Actually, how about this? I'll go through the chat and we'll discuss it at the next show, because I really can't find it now. There's so many comments here. So sorry about that one, Alex. I did see a message and I was saving it. Oh, here we go. I found it. All right, I found it.
Good.
Sorry, guys, for the delay. I'll be more organized next time. So this is the final question of the day from Alex.
Yeah.
What is more important for you, diversification of ideas, markets, or sectors?
That's a great one.
Yeah.
That's a tricky one. I will not please you, because the answer is all of them.
The diversification of diversification, right?
Yeah, but probably different markets among different sectors. Because even if you have just one idea and you diversify that idea well across different markets and sectors, you still have something viable and good. So probably, yeah.
Yep. All right. So thanks for that answer, Thomas, and thank you for everyone for attending today. We had a really great group of people, some excellent questions. So just quickly, actually, which one was your favorite tip of today? 1, 2, or 3? The first one was volatility composition. Second one, system sizing. And the third one, create adaptive environment. So which one are you going to research more and start implementing over the next, well, maybe today, maybe in the next couple of weeks? Oh, actually, before we go, while people are putting their response, I did find the link for the Empowered Trader. Let me put that up on the screen because you're talking about volatility composition. Here we go. So I've got it here. I'll put it in the chat. And then, so you can just go to this page and you'll see more info about the Empowered Trader. And you'll see there's some info about this new episode that Thomas was talking about with the, you've got to like a volatility composition toolkit in there, right? Don't you? Some code and some other things that you can actually analyze it, make it easy.
In the new issue, this is not the latest issue, but on the link there is the latest issue, and I talk more about this volatility recomposition, and also there's a video and code included, so that's all part of this Empowered Trader project that we run in BTA.
Yep. Okay. So we got All right, so we've got a couple of comments just to finish up here. Martin, I like this comment from Martin. The moral of the day: adapt or you will diminish. Adapt or die.
That's a good one. Yeah, that's a good one. I like Martin. You know, Martin. His way of expressing himself is very British. Diminish, right? Yes. Like we would say die, but you know, he's got this British sense of vocabulary. I like it. Good one, Martin. Good one.
Okay, we've got Diogo says number 1, which is volatility composition. I have to admit that's probably one of my favorite ones as well. Neil says adaptive. Very good, Neil. It's a good one too. Uncorrelated systems from Gus. So number 1. Was that number 1? Number 2,
system sizing. 2.
Yeah. So I guess everyone's in a different point in their trading journey. So perhaps one of these applies more to where they are right now. But all 3 are excellent points. So thanks a lot for sharing that with us today, Thomas. And I really enjoyed your drawings as well. I think the remarkable was remarkable, right? So maybe we can see more of that in the future.
Thank you, guys. That was the best drawing you'll ever see from me, because I'm horrible. My wife, she's an artist, and she does all these beautiful detailed drawings, and you know I'm the right opposite. That's the best I can produce. So next time I'll draw something again. So thank you very much for being with us tonight, and we'll be looking forward to seeing you in 2 weeks.
Yep, exactly. So thanks again, and we'll catch you again right here on Breakout Trading Answered in 2 weeks' time. Ciao.
Ciao. Happy trading.